Silver just took another brutal hit, straight to a level that looks uncomfortably close to a panic low. And honestly, this video wasn't even on my schedule today. I had other priorities lined up. But I watched the price action closely. I watched how the market reacted. I watched the commentary explode, and it became clear very quickly that most people are about to misunderstand what actually just happened. It's Thursday, February 5th, New York time. Drop a comment telling me where you're watching from and what day it is for you. Now, if you're holding silver, gold, mining stocks, energy names, uranium exposure, or if you're just sitting there wondering whether you should even touch this space at all, listen carefully. The last few trading sessions were not normal volatility. They were a stress test, and how you interpret this moment will completely change what you do next. Let's walk through it, step by step. We just watched silver drop hard, fast, and violently, then attempt to bounce. Headlines will blame the dollar. Others will say risk off. Some will say profit taking. Sure, those can be part of the environment. But markets don't fall this abruptly unless conditions were already primed. Recent market data showed spot silver swinging between the high 70s and low 80s per ounce, with intraday prints briefly slipping into the low 70s during the worst of the liquidation. You can see it clearly on the tape. Gold has been whipping around the $5,000 level, failing to hold above it, then snapping back aggressively. That's classic crowded trade behavior, getting forced to unwind. And here's the key point. The price itself isn't the important part. What matters is why the price moved the way it did. If you think this was a routine pullback, you'll handle it one way. If you recognize it as a structural flush, forced selling, leverage being expelled, you'll handle it very differently. So what caused the sudden air pocket? It wasn't one thing, it was a combination. First, margin mechanics. When exchanges raise margin requirements, they call it risk management. They call it prudence. But the outcome is always the same. Anyone using leverage suddenly needs cash immediately. And if they don't have it, they're forced to sell. Not because their thesis changed, because they had no choice. Second, the dollar bid. When the dollar spikes, it acts like gravity on dollar-priced commodities. It doesn't have to explain the entire move. It only needs to be strong enough to knock over the first domino. Third, positioning. When too many participants are leaning the same way, the market doesn't need a major shock. It just needs a small push at exactly the wrong moment. That's what this felt like, a well-timed shove. Now, this is where most people get it wrong. After a violent down move, markets usually follow one of three paths. I don't pretend to predict which one will happen like I'm reading tea leaves. I think in probabilities, because that's how adults manage risk. Scenario 1, the dead cat bounce. Price pops, people relax, commentators declare the bottom, and then price rolls over and makes a slightly lower low. It's the market's favorite prank. Scenario 2, the basing grind. The selling stops, but nothing explodes higher either. Price chops sideways, building a range that frustrates both bulls and bears. Scenario 3, the face-ripping reversal. Price turns sharply and violently, forcing panic sellers to chase back in at much higher levels. Which one is most likely? Historically, the market prefers scenarios 1 and 2. Scenario 3 does happen, just less frequently. The variable that changes the odds is whether the selling was discretionary or forced. Forced selling creates gaps. Once those sellers are done, price can rebound quickly, even if the headlines haven't improved at all. Here's how you tell the difference. A normal pullback shows fading volume, reasonable spreads, and gives you time to think. A forced liquidation shows spiking volume, widening spreads, disappearing bids, and charts that look like they fell down an elevator shaft. That's why these moves make people feel sick. Not because price moved, but because it moved in a way that removed choice. If you've never lived through one of these, you learn a harsh lesson. The market doesn't care whether you're right. It only cares whether you can stay solvent and emotionally intact long enough for being right to matter. So here's the first cliffhanger to keep in mind. If this was margin-driven cleansing, rebounds can come before sentiment improves. If this was a genuine collapse in demand, every bounce is a trap. We'll figure out which one it looks like, without pretending we have a crystal ball. That brings us to the question everyone keeps asking. When do we get back to triple-digit silver? Here's the answer that saves money but sounds boring. Obsessing over round numbers is entertainment, not strategy. Triple digits make great headlines. Strategy is what you do if price goes there, and what you do if it doesn't. So let's build a plan the way professionals do. First, define why you own the metal. Is it insurance? Is it speculation? Is it a trade? Those are three different things. If it's insurance, you don't manage it like a day trade. You size it so you can sleep. You don't stare at the chart every 5 minutes. If it's speculation, you need exits, not vibes, real exits. Ask yourself this question and answer it in one sentence. Under what price or condition do you sell? If you can't answer that, you're not investing, you're hoping. Now comes the paper versus physical mindset. Many people say they'll never sell physical. Some mean it. Others have never lived through a mania where price is screaming and temptation is real. I'm not here to tell you there's one correct philosophy. I am here to tell you the danger. People who never plan a sell decision often end up selling at the worst possible moment because emotions eventually make the plan for them. Here's a framework that keeps people sane. Bucket 1, long-term insurance. The portion you hold because debt is massive, systems are fragile, and you want assets outside the system. Bucket 2, ratio swaps. The portion you're willing to exchange when metals become expensive relative to productive assets. Bucket 3, tactical paper exposure. The portion you trade where you allow yourself to be wrong quickly. 3 buckets. Simple. Now let's talk about profit taking, where people either compound wealth or give it back. I prefer scaling, not because I'm scared, but because markets don't ring bells at the top and humans are terrible at perfect exits. And when price runs into obvious stretch zones, euphoric sentiment, frothy momentum, social media declaring permanent upside, I'm willing to trim. Not because the thesis is broken, but because short-term risk-reward becomes skewed. Here's the uncomfortable truth. You don't have to predict the crash to benefit from trimming into strength. You just have to respect that after big runs, pullbacks happen, even if the long-term destination is higher. That's why separating insurance from speculation matters. Insurance sits quietly. Speculation gets managed. Never let your speculative bucket become your identity. Now, about paper versus physical, without romance. Paper exposure is liquid, convenient. It's also where leverage lives, and leverage is what gets wiped out during flushes. Physical exposure is slower and boring. It doesn't get margin called. Those are trade-offs, not moral judgments. The real question isn't paper bad, physical good. It's what job are you hiring this position to do? If it's for fast upside, liquidity matters. If it's for insurance, independence matters. Yes, there are moments when selling or swapping physical makes sense. If metals go parabolic and productive assets are crushed, rebalancing isn't betrayal, it's discipline. Now let's address the conspiracy chatter. People noticed the speed of the sell-off and asked why trading wasn't paused. Here's the nuance. Different contracts have different rules. There are dynamic mechanisms that trigger halts under specific thresholds and windows. And yes, there were moments where people expected pauses that didn't happen. Would a short halt have changed the outcome? Maybe marginally. But a 2-minute pause during forced liquidation is like placing a speed bump in front of a landslide. What does matter is recognizing the plumbing. Institutions manage collateral differently. They see flows earlier. They survive margin swings. Retail traders can't. That's not villainy. That's structure. Instead of shouting rigged, learn the system so you're not blindsided again. So is this a buy the dip moment? I'm not giving advice. I'll tell you how I think. Start with allocation. Decide when calm what percentage of your liquid net worth belongs in this theme. If your target is 20% and you're sitting at 8%, pullbacks are how positions are built, not at euphoric highs. If you're already above target, the best move may be doing nothing. Execution matters. Think in layers. Layer 1, small starter buy. Almost boring. Layer 2, add if price retests lows with less panic. Layer 3, only add aggressively if price reaches levels that historically force capitulation, when volume explodes and everyone hates it. That's the difference between catching knives and building positions. For advanced traders, one misunderstood tool is selling puts. It's not magic. It's a way of getting paid to set limit orders, but only on assets you're willing to own and only in sizes you can fund calmly. Plan first, emotion second. Miners deserve special discussion. Miners aren't metals, they're businesses. They have costs, jurisdictions, dilution risk, and management risk. In drawdowns, miners trade like leveraged instruments, even if balance sheets didn't change overnight. That's why equity markets treat miners as risk assets first, metal proxies second. I separate metal exposure from company exposure deliberately. Lottery ticket explorers can double, or halve, on random Tuesdays. I avoid them unless sized accordingly. The sweet spot tends to be mid-tier producers. Real operations, survivability, upside optionality. Sometimes the metal itself is the better trade. Minor underperformance can be opportunity or warning. Ask why. Relative value matters. Not is it down, but down compared to what? When miners make new relative lows versus silver, the equity market is pricing permanent damage. Sometimes that's wrong, and rallies explode. Sometimes it's right, and reality bites. Confirmation matters. Quality names holding up, juniors stabilizing, relative bleeding slowing. Better entries feel uncomfortable. When headlines are ugly and sentiment is broken, early doesn't mean reckless. Now zooming out. Extreme camps dominate commentary. Sell everything or never sell anything. Both extremes can destroy discipline. Metals are a tool, not a religion. Money versus currency matters. Dollars are efficient currency. Metals are long-term value storage when policy risk is high. That doesn't mean metals are the only answer. Resilience comes from productive assets, skills, income, and selective cash. Global debt remains massive, around $250 trillion, creating a system sensitive to stress. Liquidity responses follow pain. Silver isn't gold. Silver is volatile. Gold is stability. Ratios help manage emotion. Central bank demand remains supportive for gold. That matters. If silver stabilizes while gold holds, digestion is happening. If both fall, broader liquidity stress. Platinum, underwatched. Smaller markets move faster. Uranium, underowned. Contract-driven. Slow squeezes turn violent. Energy, cash flow machines with dividends and mining cost implications. Watch reactions, not headlines. Bottoms form through exhaustion, not celebrations. Final synthesis. 1. This sell-off looked like leverage being purged. 2. Forced sellers are finite. 3. Your next move must follow your allocation plan. 4. Express theses diversely. Volatility tests conviction. It doesn't automatically invalidate it. Write down 2 numbers, where you add and where you admit you're wrong. Most people only write 1. Education only, not financial advice. Do your own research, think in probabilities.